Welcome to the Oil Market Insight. Now, in its December monthly oil market report, OPEC kept its demand for crude in 2013 at 29.7 million barrels a day. That's unchanged from its previous report. OPEC is currently producing about 31 million barrels a day, and the organization says that the market is very well supplied. But of course, some concerns, weakness in the global economy has influenced demand, as well as geopolitical uncertainty and speculative action on the market as well. So it's with this backdrop that we're bringing you this special oil market insight on the occasion of the 162nd meeting of the OPEC conference, and we're coming to you from Vienna. And joining me here in Vienna, my guests for this special edition too, I'd like to welcome Jason Schenker. He's the president and chief economist with Prestige Economics. Let's move swiftly over to America. Jason, we're appointing you spokesperson for what's going on in the American market. And we're seeing huge production coming out of the US like we've never really seen before, 6.5 million barrels at the moment. Will this contribute to oversupply in the market, or is this really feeding into domestic demand?
Well, you know, it is going to have a huge impact because it is a global marketplace. And if you look at OPEC's expectations in the world oil outlook for 2012, you see not only is the United States going to be a huge producer year over year in terms of increase this year, but also next year as well. This is going to continue. The United States has been the area that has the, and actually North America as a region, has had the biggest increase to global oil supplies both this year and next year, and that's going to continue for a number of years. So that's going to be really critical for the global oil market dynamics. But at the same time that you see the increase of supply coming from the United States, demand is really going to come from emerging markets, and emerging market transportation fuel demand was very strong this year. That's where you saw the increase in demand. OECD demand peaked in 2005. It's been lower since. It's going to go even lower. It's really the emerging markets where that demand's going to come. So it's good that you're seeing out of the United States more supply, because we need it on a global scale.
But Bill, we've seen those emerging markets as well pull back a little bit. When you look, you've mentioned China and India, and indeed China was really the main growth driver for the last while. But how important is it that China sort of re-emerges in a way, because it's pulled back a bit, but I think we're still looking at very strong growth figures indeed compared to the rest of the world. And even in terms of India, we haven't seen as much impetus or much momentum there as we would have liked.
Yeah, I mean, people shouldn't overplay Chinese softness. I mean, they're still growing at 7%, which is pretty substantial. I think the issue that the oil market is getting used to, though, is this flatlining or contraction in OECD oil demand, which is a new feature. Jason, you
want to come in on that one?
I'd love to jump in on some of this too, because if we look, this year there were about 800,000 barrels a day of additional demand added. 400,000 came from China, 300,000 came from India, and other Asia, and about 100,000 came from the Middle East. So China was really half of the additional demand. You're looking at 7% increases in annual auto purchases. You know, we think about what's the per capita demand of oil consumption globally. In the United States, it's about 60 thousandths of a barrel per day of oil. In Brazil, it's about 4.5 times less than that. In China, it's 1/9 of that. And in China and in India, it's about 1/20th of that level. You don't need to move the China and the India numbers that much. You know, China's demand 1/20th that of the United States. You don't need to move it too much before you increase oil demand a lot. China's number, 1/9 that of the United States. If it just doubles to, say, the level of Brazil's, you would see an additional 9 million barrels of additional oil demand per day. And that's something we're going to see over the next 10 to 15 years. So we're going to need every extra barrel, as Cornelia said, we're going to need every extra barrel we can get, because these emerging markets, they have such low penetration of automotive purchases, of automotive usage. That's going to go up in a really exponential fashion. That means OECD countries are going to be forced to really push down, especially the United States, push down their per capita consumption of oil, and that means push towards more efficient vehicles, more hybrids, smaller vehicles. This is going to be really critical. Transportation fuels are everything over the next 25 years.
I see you want to come in on this one, Cornelia. Yeah, please.
And I would agree that China is very important, but we see China slowing, and we also have to see that China is doing a lot of research on how to lessen dependency on fossil fuels. So China will go probably quicker than the OECD countries in that way. What we should not forget is the N11, the next 11.
Yes,
you know, the Nigerias, the Middle East, the Indonesias, the Vietnams. And that's where you will, over the next, I think, 5 6 years see the big impetus in growth. And if you add up their populations, it's not quite China, but it's nearly China.
And there, you know, it's a peaceful part of the world now, and there's a lot more growth and a lot more disposable income. So you've got more consumer demand, which ultimately, hopefully, means more oil demand.
And along these lines, to play on what Cornelia said, if we look at sort of the 4 biggest countries that are growing over the next 50 years or so, you know, it's India, it's Nigeria, it's the United States, and it's Pakistan, which is interesting that the United States is in this sort of top 4. So you still see the U.S. as a growth market, other markets where you have significantly lower automotive penetration. These areas, they're going to continue to see it. In the U.S., it's going to be a push to get the lower per capita consumption, but you're going to see it rise in all of these other, the next 11. Really big, really
But a word of caution, what we've seen with the OECD is that taxed fuel is at the limit.
Well, of course.
And we're even seeing governments defer taxation now or cancel it entirely because they are seeing, you know, double-digit contraction in liquids demand. So we have to differentiate between taxed fuel regimes and untaxed fuel.
Yeah, but then we have to bring in something else, which is subsidized fuel, because in a lot of the N11s and even in China, you have quite a bit of subsidy, and the Middle East, and they will keep. And the Middle East is less. The oil producers is less bad if you have subsidies. But if you look at China, at India, at Nigeria, which is a producer, the subsidies actually eat quite a bit into the budgets, and that you will see probably go down, which will have a little bit of a slowing impact on the demand growth.
You know, and to back up what Bill said, you know, if we think about the higher taxed fuel regimes like Europe, the U.S. per capita consumption is double that of those regimes. The U.S. consumption per capita of fuel consumption, double that of Germany, double that of France. You know, and that's why there's this pressure, because you know, at the end of the day, really, transportation fuels are still really cheap. Yeah. The value you get, and sometimes I talk to other clients, they talk about the BTU content. It's not about the BTU content. The value of the fuel is the value of transporting a good from one market where there's a lower price to another market where you get an arbitrage, and the difference between those two prices, that's really what the fuel's worth.
Right, yes.
Right, so diesel, which had more than 50% of the growth demand over the past year in terms of transportation fuels, and of that 800,000, 400,000, that was more than 400,000 was diesel and gas oil. You know, it's that transportation fuel, moving goods around the world. That's a real big thing for economic growth, and that's what we're seeing, and that's why the regimes that have higher taxation, they really need to be considering that, because you need this stuff for growth. But at the end of the day, on an untaxed basis, it's still really cheap.
I want to just pick up the economic growth story, and particularly in America, and just you know, get your response on this. How dangerous is the fiscal cliff right now? And I know people are still looking to the Fed, but what on earth can the Fed do that they haven't done already in America?
Well, I think these are two different stories.
Yes, of course.
You know, the Fed story is really about growth and what's the Fed doing, and the Fed's expanding its balance sheet, and you know, this has a growth stimulus, but it also has longer-term risks. You're creating this off-balance sheet entity that gets bigger and bigger and bigger. You're throwing stuff into it, and someday you might want to unwind that, and when you do, it gets messy. In terms of the fiscal cliff, what this really means is there are a series of tax cuts that are set to expire at the end of the year, and there are also some budget things that are expected to be cut at the end of the year. If it all happens, the United States will be in a recession next year, somewhere between a -1% and -3% GDP.
And that will have a knock-on effect right across the world.
But I don't think it happens. What I think we see, you know, I like
it'll just pull back.
That's right. I think, you know, I like to tell people, in a pre-industrialized society, I like to think I would have been a fortune teller. You know, and when I look forward, I see here that what we would see is a partial, short-term, last-minute, temporary solution that buys you a little bit more time to actually fix the problem. You don't get a real resolution right now, but the politicians, they have to posture until the last minute in order to prove to their constituents that they tried as hard as they could. Really, we really did. We had no other choice. We had to make a deal, right? And that's how the political system works. So you drag it out as long as you can. You make a deal. It might be 11:55 p.m. right before a midnight deadline. They're going to make a deal. They have to make a deal. They don't have a choice. But it's a matter of convincing those political interests that if you don't make a deal, the recession we get is worse than any increase in taxes that may happen.
You want to come in on this one, do you? You're very eager, I see there.
Yeah, I say, yeah, well, we may get a deal. We may also temporarily not get a deal, but even if we don't get the deal for 10 days, the impact that will have on markets will be quite devastating, which will have a loop-back effect on economic growth. So I wouldn't be, and so I would say we may get a deal. I'm not quite as optimistic as you are on the deal, because we have seen it time and time again that both sides of the aisle couldn't reach out when they needed to reach out. And so there is a real...
But everybody will want that deal to happen. I mean,
everyone
they do.
wants a deal to happen, but Cornelia is right. If we don't get a deal, it will push oil down, it will push equities down, it will push industrial metals down. It will have a huge negative impact on market sentiment for growth, for the U.S. economy, and for the global economy. Because right now, with Europe trying to dig its way out of recession even next year, kind of hoping for flattish growth, the U.S. is looking like a pretty strong economy. When we think about China, China's the midstream. China makes the stuff that the U.S. and Europe buy.
Yes,
and if Europe is still soft, and the U.S. goes soft,
no, then Chinese manufacturing's down.
Then China's soft, and then the whole global economy is soft.
I agree with you to a certain extent, but if you really look at Chinese output, it used to be the story of it all going to the U.S. The biggest market for Chinese output at this point is Europe, which is very disconcerting. But there's increased domestic demand and there's increased interregional demand. So China is no longer as dependent on U.S. and Europe as it used to be.
And I completely agree with that. The thing about Europe, too, is Europe's also one of the best markets where they can get pricing. Not only is Europe a key end market, but it's one where you can get good margin.
Thank you for that. Well, thanks for that. We're going to have to leave it there. I'm very sorry about that. We will talk more about this, and I want to thank you all for watching here. We do want to remind you, too, that please stay in touch with us. Give us your comments and send us your questions anytime now and indeed throughout the year. Webcast@opec.org. That's webcast@opec.org. We're always open to hear what you're thinking as well. I do want to thank my guests. I want to thank Bill, thank you so much, Cornelia and Jason for joining us here at this Oil Market Insights. And that's all from here. Thanks so much.